Welcome to Larkin Gowan Insights, accountancy and business advice for all, a series that gives you bite-sized tips and guidance on tax, funding, legislation, reforms and much more. With case studies, business advisory and sector specials and even interviews, our team of experts are committed to helping you navigate the world of accounting and finance with a variety of presenters from across our specialisms. So, let's get on with today's show.
Today's episode is on exiting the business in our series of life cycle of the business. Today we are joined with Becky Ames. Becky, would you like to introduce yourself?
Hi, Alanah and Megan. I'm Becky Ames. I'm a partner in our business team, usually based in Suffolk, but can also be found in Norfolk.
So it's a very topical thing at the moment, exiting a business. It's the 1st of October when we're recording this, so it's budget month, and with lots of speculations, it's been something that we've been talking to our clients a lot about, isn't it, Becky?
Yeah, definitely. Lots of people want to know whether they should do something sooner rather than later, get in before the budget. As ever, our advice is don't do anything purely for tax reasons or speculation. But yeah, we've had lots going on.
And it's never too early to start thinking about what you want to do and when you might be looking to exit a business and how you want to exit a business. So should we just have a talk about all of the different ways that you can potentially exit your business?
Really, I guess the key point for me is that you do need to start planning sooner than you think. And it's really about understanding why you want to exit. So, is it retirement, or is it the business has naturally reached an end of its life, or is it perhaps you're looking to sell the business on having grown it or achieved your goals and move on to your next venture? So, that's really important. And I guess the worst scenario is if a client says to us, I want to exit in the next 6 months, because that doesn't really give us a great deal of time to plan anything, does it? The best scenario is sort of a 2-3 year plan at least, to get the business ready, particularly if that's for sale. But there's lots of variations in between.
No, definitely. I've got a few clients that say to me, oh, when I want to exit the business in 5 or so years, and it's not necessarily coming up with a list of things and a definitive plan, but it's more just us having an awareness and having those conversations early, isn't it?
You know, people all have different plans for their lives, and circumstances change frequently. As we know, those plans can change. So it's being in a position to be able to be agile. There might be an opportunity. Someone might come knocking on your door and make you a fantastic offer for your business, but you can't react too quickly. You still got to put the plans in place and make sure you're doing it the right way for you, for your employees, if you have any, and also obviously for tax implications as well. And ultimately, you want to get what you think the business is worth, or at least understand what it's worth to be able to make an informed decision.
So we've discussed in previous podcasts about the succession plan, the growth, and so now coming on to the exit, how do people know when the right time is? So you said about the employees, the right time for you. What have you seen some examples of that when the right time really did come about?
Yeah, there's lots of different scenarios. So there might be someone who essentially is their business, and therefore, when they've reached the point where, for whatever reason, you know, it might be the challenges they're facing or the opportunities for the reasons they went into business in the first place have come to an end, the natural life cycle, as you say, of the business. It might be a change in their circumstances. We saw lots of people after the pandemic who sort of accelerated their plans in terms of what they might want to do with their business. And you know, we all had time to stop and think, I guess, and perhaps considered what else they might want to do with their lives, and it might no longer be that business. So there's lots of different scenarios. I think if you've grown your business with a view to sale, there's lots you can do to prepare for that, obviously. If there is an event in your life which prompts you to need to exit your business, you know, sooner than you might have anticipated, there's still some planning we can do. But again, we you know, people's lives take over, don't they? And we
Yeah.
would never say, you know, no, don't do it. There's always a way to get to the solution that we need. It's just how we structure it and make sure you have the right advice along the way.
Yeah. So first one you mentioned was selling your business. So if you've looked at your growth strategies and you've been gearing up ultimately to sell it, so then you have your lovely little retirement pot at the end.
Yeah.
So what does that actually mean when you sell your business?
So if you are a company, you can either sell your shares and someone will acquire your shares in your company and buy the whole legal entity with the trade inside it and all of the assets that you choose to leave in your business. If you want to sell your trade, that's a different thing. If you're trading as a company and you sell your trade, the company will receive the sale proceeds. So the money will be in the company, and then we need to look at how you get it out. In my experience, we don't see as many sales of a trade. Primarily, the challenges of then getting the money out of the business, it's not as tax effective, but sometimes there are reasons why a purchaser might want either the whole trade or just some aspects of it, and not either the history of the company, because obviously that passes when you sell the shares, the whole legal entity passes. So they might not want the history, they might just want to bolt on your trade to their existing business. So there's lots of different structures and ways to do this, but typically if it's a limited company, we see a sale of the shares, usually to a third party, but that can also take the form of a management buyout. And the most important thing to think about is, well, there's two aspects really. One is before you decide to sell, you need to understand how much you want to achieve for your business. And that can be a really long-term planning exercise. And we definitely recommend speaking to a financial advisor who can do that cash flow forecasting for you. So typically someone who's built their business up and is looking to exit for retirement purposes, when can they exit and how much do they need to achieve to be able to have the lifestyle that they would hope for in their retirement? Sometimes people need to achieve less than they think because they forget maybe that the mortgage will be paid and they won't be supporting children in school, university, etc. Or it might be that they actually need more than they think, depending on what they want to do. So all of those things can be factored in and different models looked at to see what might be, what value you might want to achieve. Of course, it's like selling anything. You only get what someone is willing to pay. So then it comes down to understanding what market conditions look like. And that's when you need to speak to someone who is expert in valuing and selling businesses, such as the corporate transactions team that we have at Larkin Gowan. And they will really look at valuing the business, and that can be done in various ways, but depending on what you want to achieve. So if you're going to sell, as I mentioned earlier, to your management team, if you're going to sell to an external third party, all of those things might determine a slightly different valuation depending on how quickly you want to get out and how you plan to do that.
So you've touched on management buyout, and that links to one of our previous episodes where we talked about identifying key individuals of the business, and the clues in the name really, management buyout. But we've seen that a few times, haven't we? I'd say with the management buyout, it is interesting to see how the team then run with that business and that way of exiting the business. So the customers, they still have the face of the business, don't they? They still have their key contacts. So it almost runs just with a separate owner.
Yeah, and again, there's lots to consider. So you might sell your business and all of your key employees would stay with the business. And indeed, you might stay in your business for some time. If you do a management buyout, then as you say, the name indicates that the management team are going to remain the same. And they're the people that you've incentivized and retained and hopefully are aware of your plans.
Yeah.
Often we speak to business owners and they think that these key people will want to acquire the business because why wouldn't they? You know, it's an amazing business. And actually, perhaps those people don't know that that's what the plan is. So there's a lot to be said for being transparent with your key people about actually this is what it could look like. Are you up for this? And do you have any access to finance to make this happen? And of course, lending will come into it, but do they have the appetite for it as well? And what would it mean for them? And who would they want to enter into that sale arrangement with alongside them? Would you need to still be in the business? That's very typical. Any sort of sale, really. There's often a period of time where the long-standing owner remains in the business for a period. So there's lots of things to think around with the management buyout. They, in my experience, they can be rather emotional at times. They're people that you've worked with for some time, and there's a lot of emotions at play. This is your baby that you're effectively selling and handing over to someone else. Might be people that you've nurtured and trained yourself. So you've got to feel that you have that ability to trust that they can take it on and let go ultimately. And I think that's true of any disposal of your business. You've got to be able to let go. You've got to take the emotion out of it at some point, because otherwise you're never going to be able to walk away or separate what is effectively a business deal from something that's probably been, your kept you awake at night and kept you busy every day and has been a massive part of your life for so long. So there is an element of having to mentally prepare for this. And I think if it's a management buyout, sometimes that adds a whole other layer to it.
Yeah, that's really true. Actually, I've had someone recently that is going through exiting the business, and the stress that it actually does cause is, it's not an easy option, isn't it? Is it, when you do have to pass your baby over?
Yeah.
It's nice though when it's a management buyout and it's people that have worked in that business and helped you grow that business. But
Yeah.
it really does come down to that communication, that they know that that's the plan. Because
Yeah.
like you say, if the funding isn't there or the appetite and they're not going to take it and run with it puts you in an awkward position when maybe you become that you have to get rid of the business.
Definitely. I think a lot of business owners can be quite secretive, private about the financials as well for a lot of the day-to-day running of the business. And you need to be open and transparent and really share those details with people if you expect them to literally buy into what you have worked a long time to create potentially. And I think, transparency is key. Having those open conversations, of being clear with them what the opportunities are, what you think they are, and where they can go, and be prepared for some pretty tough conversations. As much as these people might have been very loyal to you throughout, they're now taking on the responsibility, and they've got to understand that what they're getting, and there might be some things that you would hope you think they would know or assume were okay in the business, that you'll have to answer tough questions on. Simply because it's a management buyout doesn't mean you can avoid that whole due diligence process and all the legals and everything else that's needed. So again, it's taking the emotion out of it. And I think sometimes that can be really challenging for business owners.
So, Becky, you mentioned at the start when we were talking about the different ways to exit a business, about just the business coming to the end and naturally coming to a close. So, did you want to just delve into that a little bit further?
Yeah, of course. So some people might have set up a business purely to explore an opportunity that they identified, and maybe time's moved on, it's come to an end. Or they might have set up a business incorporated because it served them well in whatever trade they were in. So for example, medical consultants that have a private aspect to their role may choose to put that through a corporate. And then when they choose to retire, there's no one who's going to naturally take on that business from them. There's nothing to sell. The business is them. And often that is the case. So then we'd be looking at how we can wind up that entity, again, often a company. And that is a legal process. We need to remember that a company is a separate legal entity to the individuals concerned, and therefore it needs to be dealt with appropriately. So if the assets, if the reserves of the company are over 25,000, you'd need to go through a members' voluntary liquidation process, which is a process that a formal liquidator would need to be involved in. Again, we have a team at Larkin Gowan that can assist with that. And that's to make sure that all the assets are distributed to the shareholders appropriately, and all of the matters are dealt with. That process is a legal process. So the liquidator basically takes control of the company, deals with all of those distributions, and then that closing down basically means there can be no comeback on the business or the business owners in the future, because everything's been dealt with through the correct legal channels, and it's over a period of 3 to 6 months typically. So it's advertised in the right documentation, in the right channels, sorry, which I think is still the London Gazette.
Yeah.
That historical thing that we always refer to. So that allegedly anyone who's got a claim against the company will have had notice that it's going to be wound up, can have made a claim in that period, and the company can be closed with no further comeback against it. So that's the full legal process. Alternatively, a shareholder in a business may choose to run the company reserves down over a period of time by drawing them out. And this would depend on personal tax position ultimately, because under current tax rules, which of course may well change in the budget, it could be tax efficient to draw down those reserves as dividends over a number of years, depending how they want to do it. And once the reserves are down below 25,000, then you can do a simple strike-off procedure, which is very simple. It's a form exercise. Again, notice is given in the London Gazette, so anyone can be aware that the company's been wound up. But that format doesn't preclude anyone from making a claim against the company in the future. So that really is for very low risk entities where there's not likely to be anything. Now, of course, we would hope there wouldn't be anything anyway. But if you want to make sure you've done it all properly, members' voluntary liquidation is certainly the advice we would give.
So another way of exiting the business that we certainly see a lot within our team, where we have a lot of family businesses, is the sale of shares to family members, or even, if they're lucky enough, a gift of shares.
Yeah, and we do see a lot of that, and that's what a lot of our inquiries have been about in advance of the budget as well, where the speculation is in respect of capital gains tax rates and inheritance tax rates. So if a shareholder chooses to pass down the business to a family member, then that could be either through a sale, so the family member would pay them for those shares in the usual way, or they could gift their shares. And we do see a lot of that, you're right, Alanah, and that might be over a period of time. We might pass control over gradually, particularly if the shareholders, let's say, are husband and wife and they want to gift to their children. They may choose to gift shares over a period of time, maximising tax reliefs for capital gains tax purposes. And gradually, as they deem appropriate, the child or children may then take control of the business. And throughout that period, all shareholders would be entitled to dividends, perhaps, and therefore the parents, the original owners of the business, could still have an income from the business. We might choose to change the structure of the shares so that we use alphabet shares to vary who can receive what dividends. But all of this would need to be considered in the particular circumstances. So it gives flexibility.
And another thing when you're gifting shares to think about is things such as the valuation of a business, which are sometimes not appreciated, because in simple terms you're gifting the shares, but actually there is a lot more to think about, and it is still a case of let's start thinking about these things early, isn't it?
Yes. So you'd need a valuation of the shares whether you're selling them to a family member or gifting them. If you're selling them, you need the valuation because you're selling to a connected party. And clearly, if I had a business that was worth £1 million and I'd like to sell it to my daughter for £10, there's an issue there because I've disposed of my shares and I won't have paid any capital gains tax allegedly. So it needs to be the market value that's taken into account in that scenario. If I were to gift my shares, I can either pay the capital gains tax now in terms of the market value of those shares, or I can defer that gain. I can hold it over, and that involves both me and the person I'm gifting them to making a claim on their relevant tax returns for that relief. And then the gain that would otherwise be payable to me would be roll over into the value of those shares as and when the person who's receiving the gift disposes of them. Now, if the plan is to always keep that business in the family and gift it through the generations, you can see that the gain could be deferred based on current tax rules, of course, which are subject to change. But as long as there is that sort of relief available, that is possible.
So thinking about this practically, you're a business owner, you've decided that you want to start thinking about exiting the business, and I know you've touched on various tax implications. Are there any reliefs available at the moment for anyone
At the
thinking?
moment, yes, which is why everyone's been getting very excited in case these reliefs are changed anyway. So currently there is business asset disposal relief, which replaced entrepreneurs relief, which replaced retirement relief. So there has been something in place for quite some time. And I would speculate that there will always be something to incentivize people to be entrepreneurial and go into business and know that when they exit, the rates of capital gains tax aren't going to penalise them. Now, saying that, I'll probably be proved wrong. But business asset disposal relief ultimately means that an individual can make £1 million worth of gains on disposal of shares or their business in their lifetime and pay 10% on that. And anything over that would be taxed at the usual capital gains tax rates. Now, that's really advantageous for our typical family business, perhaps that is selling their shares, selling their business. And the key there is to really make sure you've got the shares in the right place before you sell. So one of the qualifying conditions is that you must have held the shares for 2 years. So this is why planning is really important, to make sure the right people have got shares. You must have at least 5%. So you can make changes to that percentage up to the date of sale, but for 2 years you have to have held 5%. You also have to have been an employee or an officer of the company. So that means that if you are not a director or an employee, you wouldn't be eligible for business asset disposal relief. And a key point there is to make sure that you don't resign as a director before you sell your shares, because we have seen that scenario, and that means the relief would not be available to you. So just make sure you don't do anything impulsive. It would be my advice, really, prior to this. But you think about perhaps gifting shares between spouses in anticipation of sale, where one has had a minority shareholding in the business and the other the majority. You could perhaps equalise those shareholdings and therefore maximise capital gains tax allowances and reliefs in that respect. So there's things to think about, certainly in the shareholdings, but it needs to be done in advance based on current rules, because there is this 2-year limit. Other things we want to think about outside of tax relief probably is just making sure the right things are in the business before you sell it. So, for example, if you've got a property in the company and you don't want to sell the property, getting that property out either to your pension scheme or to you personally or into another company, because if you're selling the shares, you're selling the whole company and everything in it. Perhaps you want to retain that property and maybe lease it to the new owners of the business, and that would generate income for you in your retirement. So really good tax planning that we're seeing with clients recently is that their pension scheme, they fund their pension scheme through contributions from the company. The pension scheme acquires the property from the company, so it's outside. They can then sell the company or not, but at least they've got the property outside, which the company will then pay the pension scheme rents. So they've got an income stream there, building up their fund for their retirement. And that can sit there and generate you income for as long as someone is using those trading premises, and you can rent them to a third party, for example. So that's a really good way of making sure, first of all, that you're maximising what you're going to have for your retirement, but also making sure the assets in the business are the ones that you would want to dispose of and someone would want to buy, because that's another key point. You know, things like directors' loan accounts will need to be resolved as well prior to any sale. So if you owe your company money, of course, that will need to be paid back because someone's acquiring your company. And if the company owes you, then that needs to be sorted out as well. That can often be part of the sale, but my advice would be, if you're looking to sell your company in the next sort of 3 to 5 years, first of all, demonstrate the working capital requirements of that company, because that will really help when it comes to the value that you are able to achieve. You know, everyone wants to minimize their working capital as much as possible. And also, any cash balance, no one's going to pay cash for cash. So how are you going to get your cash out ultimately? Because if you've got a really big cash sum sitting in there that's built up over a number of years, a potential buyer isn't going to want that necessarily. So, you know, why would they pay £1 million for your £1 million cash sitting in the bank account? They wouldn't. They don't need it to run the business. So how are you going to get that out? Is it pension contributions? Is it other remuneration planning? And again, that can take several years to wash through and to get you to the point where you want to be. So it's really important to plan ahead. And this is where your financial advisor and your accountant, as well as someone who's specialist in corporate transactions, can really work together and make sure that you're creating the best possible scenario for you to sell your business.
I think that is one of the main benefits of being with Larkin Gowan, isn't it? We have those specialists in those areas, so we can talk you through kind of the general, help you choose which option you'd like to go for. But ultimately, there's always someone there that's been through the process before, knows it inside and out, and can really guide you through something that could be quite stressful. But at the end of it, with the correct target for what you want at the end.
Definitely. The guys in corporate transactions have seen some really significant deals, and also, you know, some some much smaller, reasonable sized ones. So they understand all the emotions that are at play. They understand a deal can be on, then off, then on again, and how it can keep changing. They're really expert in taking a company, a business out to market, and they will hold your hand the whole way through. And I think that's so important, because something that you've built up over a number of years, it's a real wrench to let it go. Sometimes it might feel like a massive relief once it's done. But that whole process, you really need the right people on your side to guide you through. And the tax advice along the way is important. You don't want to do something the wrong way. People will throw things around like deferred consideration, earnouts, things like that. You need to understand what you're getting into, what it means for you, both in terms of your ongoing presence in the business and commitment, but also what it means for your tax, and make sure that you have any sale and purchase agreement reviewed from your side of things in terms of your personal tax position and all other shareholders, because it's really important to understand the implications before you enter into anything.
And as you say, it really is what it means for you, because every sale is different. We've never seen two sales that have been exactly the same.
No. That's a fun part, isn't it? I mean, and this stuff is exciting. It's a culmination of your years of hard work and what you hope to achieve for it. And hopefully you'll have this sum at the end of it, which you can then choose to reinvest in some way. And that might bring further tax reliefs, actually, in terms of if, depending on what you want to do. If you want to retire, how will you invest that money to make sure it's generating an income for you? If you're not ready to retire yet, are you investing in another business or premises that someone else is going to trade for? There could be some reliefs available there for you in terms of reinvesting the money. So there's lots of things. So it's not just up to the end of the sale process where we can advise, it's beyond as well, and make sure that you're getting, the most out of that money that you've worked so hard to realise.
So, Becky, we have started a trend in our podcast series.
This is Alana's favourite bit.
It is. What 3 top tips would you give to any business owner who is thinking of exiting their business either now or in the future?
I would say, number one, start planning before you think you need to. There's nothing like a plan. We all say that, a business plan, but planning for exit is key and takes time, and you want to get it right to maximize the value of your business. So consult the experts, both in terms of your personal wealth and your business tax advisors and accountants, and make sure that you've got all the information. The second thing I would say is, and this is tough, but try and keep the emotion out of it, because once you've made the decision to sell, you've kind of almost got to step back a little bit and let the process happen. Of course, you'll be engaged throughout and it will be stressful at times, but once you've made that decision, you've got to let it go. It's a bit like when I decided to sell my house, I was like, that's it, it's done now. I've moved on to the next one, and you almost do. So I think maybe having what the ultimate goal is, why am I doing this? Is it all my retirement plans? Is it my next business venture? Keep your eye on that as well, because that's what will drive you through. And I guess the third one is understand what you're going to do with the money afterwards, ultimately. Because it's all very well realizing this, but you need to make sure you've had the right advice to maximize it. And then what are you going to do? So that, again, is about looking at your personal financial position, tax planning and things like that, and making sure it's going to give you what you really hoped it would. All those years of hard work, they've got to pay off. They've got to give you the rewards that you ultimately want. So make sure that you've had the advice and you've done the proper planning along the way. And good luck with it all.
Thank you, Becky. I can certainly see why you started the podcast saying, please give us more than 6 months' notice if you would like to exit the business.
Yeah.
And thank you for joining us today. If anybody would like to contact either one of us to discuss the potential exit of your business, you will find our contact details in the show notes.
Thank you for joining us for Larkin Gowan Insights, Accountancy and Business Advice for All. Don't forget, you can find more information about today's topic and more about how our team of experts can help you in your business by visiting our website, larkin-gowan.co.uk. Join us again next time for another fascinating insight into the world of accounting and finance.